Hello and welcome back to the channel. My name is Zach Collins and this is financial education. Today is not going to be a video for everyone. It's quite niche, but it's also a very interesting topic. If you're a finance nerd, that is, you'll enjoy it. If you just want to hear about how to 10x your money in 2 seconds, this video is not for you. Now that I've said what I'm talking about, what is the topic of discussion for today's video? Division 7A of the 1936 Income Tax Assessment Act. Yeah, if you think that sounds boring, it kind of is, but it's also super important to our taxation system and something a lot of people with a lot of money try some really weird and interesting ways to get around it. If you've never heard of Division 7A, what is it? To keep it brief, Division 7A is trying to find a way to counter interest-free loans from companies to shareholders and their associates of these companies. You might be asking yourself the question, why is this something the tax office is trying to stop? Theoretically, there are two ways you can extract money from a company. Actually, let me stop right there. The first thing you need to know, and I've mentioned this in a previous video, is that companies are their own legal entities. Just like you are a legal entity. You're separate from your partner, from your family, some random person down the street. You're all distinct. Company's the same. A company is a unique legal entity that's separate from the shareholders. It means that all income generated by the company, all expenses incurred by the company, all assets owned by the company, and all liabilities owed by the company, they're the companies to deal with. Now, if this company, for example, is making a lot of profit, starts to build up a cash reserve, what happens when they have so much cash they can't possibly use it effectively? This is where we get it on track and talk about the two ways that you can extract money from a company. That's either as a dividend or through a loan. If a company pays a dividend, it means that whoever is receiving that dividend will pay tax on that dividend because dividends are classed as income. A loan, on the other hand, needs to be paid back. And if it needs to be paid back, technically it's not income. So therefore, people try and use loans to get around paying tax. This is where Division 7A comes into force. When most company directors want to loan themselves money, who doesn't want to do it at no interest? If I can have an interest-free loan, why wouldn't I take it? Most of these people consider the business assets just to be an extension of their own personal assets, even though, as I said earlier, a company is its own legal entity. A company assets belong to no one but the company. And because the director thinks that they own the company's assets, that's what they do. They will buy a car in the company name and claim a tax deduction, but will use it personally. I've seen it done with a Ferrari. Like, come on, name me a company that needs a Ferrari. Other than luxury car dealers. None. There is no scenario where a company needs a supercar. It could also be property. A company will buy a penthouse or luxury real estate down on the coast, or even in other countries that the director will then use on business trips or what other excuse they use. I've seen so many people on Reddit say, I'm going to lend myself cash, I'll put it in my offset, and then I'll pay it back. Or other stuff like that. There are also people that will, lend it to themselves and then never pay it back. All of these scenarios could be considered under Division 7A and would result in one of two things happening. So either the ATO will deem it a dividend. What is a deemed dividend? So they don't actually need to pay a dividend. The ATO will just say it's a non-compliant loan. The amount you've given, we're just going to consider that as a dividend and we're just going to make you pay more tax. If the ATO does deem it to be a dividend, then generally they'll deem it as an unfranked dividend, which means that there's no franking credits, which these high-earning business owners do not want. If you don't know what franking credits are, basically it's tax the company that's already paid on profit, so you don't actually need to pay that again. So you get it as a tax offset, and it stops the issue of double taxation. There are a lot of ways that people try to get around Division 7A. And like I mentioned before, with the offset account, what a lot of people will do is they will transfer the money, say at the start of the financial year, and pay it back on the last day. This way, the loan is technically not on the balance sheet when they do their accounts. And then once the new financial year starts again, they'll transfer it right back. Smart, right? Well, no. So during an audit, the ATO will ask for your bank statements. They actually don't even need to ask. They're able to go straight to the bank. Anyway, the ATO can see these transactions, and this can contravene something called Section 109R, 1936 Income Tax Assessment Act, because these are basically sham repayments of the loan. The other common one is using interposed entities. If you don't know what an interposed entity is, it's where basically there's another entity in between the transaction. Let's do a simple example. Let's think about your job. Let's say your work has a few different levels of management. You do all the day-to-day work. You've then got a manager that oversees a few different staff, and above them is the owner. Now, the manager in this scenario is an interposed entity of your work. The owner creates the work. They'll then tell your boss about what this work is, and then they give it to you. And at some point, you then give the results to your boss, and they give it to the owner. Now, you and the owner are communicating through this middle manager. This is how interposed entities work. Interposed entities make it a little bit harder for the ATO to work out these loan structures, but believe you me, they know. And so what people will do is they will get the company to lend to a trust, and the trust will lend to the individual as a way to bypass Division 7A. Why would they do it like this? So there's a few reasons they will do this. So trusts are allowed to lend to individuals interest-free. They can lend to anyone, they can lend it to a company, to another trust, or to an individual, and it can all be interest-free. Same with companies. Companies can lend to, other than individuals, they can lend to trusts, and they can lend to other companies, interest-free. The way they use the interposed entity is the company will lend to a trust, interest-free. As I said before, this is allowed. Then the trust will then on-lend it to an individual, again, interest-free. And as I said before, this is also allowed. In this, there are two separate dealings and scenarios that would be allowed. However, due to essentially, just using the trust as the middleman, what we're ultimately talking about is a loan from a company to an individual. Due to this, it's classed as a Division 7A loan. Now, it doesn't matter how many interposed entities, the ATO can and will trace it. I've heard scenarios, where there's more than a handful of interposed entities, and ultimately gets traced back to the basics of Division 7A, and this falls under Section 109T of the 1936 Act. Now, you can enter into a complying Division 7A loan. This loan is actually quite a high interest rate, and it's above what you'd expect from, say, a third-party lender. The reason for this is to discourage the use of these loans. When you have a complying Division 7A loan, you can do it either from a 7-year or a 25-year term. So 7 years is basically an unsecured loan, while 25 years needs to be secured against something. Normally, people use property. Now, these loans are fixed rate from the year that you take it out, and you can find a specific rate on the ATO website. These loans will also have a minimum yearly repayment, or MYR, and they will have the same minimum repayment throughout the life of the loan. It makes it super simple for the ATO to know if you're actually paying the right amount or not, as they know what the MYR is, and they can verify with your journals and bank statements if you've actually paid it. Hopefully I've been able to give you guys a little bit of a better understanding of what Division 7A is and how other inter-entity loans work, even if just from a surface level. If you have any more questions, please feel free to drop a comment below and I will answer it if I can. Thank you guys so much for watching, and I'll see you on the next one.